Hi class, I am ready to start. Quick study 4-4 in your Wild book. It's page 195 if you're looking at the book, or if you're looking at the book on in the e-book version. Okay, it's page 195. Okay, so this autofocus is not really working. Let me see here what I can do about this. Okay, stay like that. Okay, so November 5th, purchased 600 units of product at a cost of $10 per unit. Terms of the sale are $210, net $60. The invoice is dated November 5th. Well, first of all, let's just record the purchase, and then we'll talk about the terms. Okay, so we are using perpetual inventory, so we are going to directly debit right into inventory for 600 units at $10, so $6,000. And obviously, we haven't paid for it yet since they're telling us that the net is due in 60 days, so that's going to go to accounts payable. Okay, so what does that 210 net 60 mean? Well, what it means is they wish that we would pay them within 10 days, and they would like to have their money so quickly that they're willing to let us take a 2% discount if we'll pay on time. Okay? So, we'll see how that works. November 7th. Returned 25 defective units from the November 5th purchase and received full credit. Okay, well, when we're in perpetual inventory, and this is going to be confusing because we do not do it like this on the sales side. When we return things, we actually just reduce our inventory for what we send back. Because in a perpetual inventory, we want to know what we have all the time. So I'm not going to pay them anymore for what I'm returning. So I'm going to reduce accounts payable for 25 units at $10. So that's $250. And I'm going to reduce inventory for $250. Now what I'm going to do is over here as a sidebar, I am going to keep a T account for accounts payable, because when it's time for me to pay my bill, I need to know what I really owe them. So originally we owed them $6,000, we returned $250. So at this point we owe them $57.50. Okay? Okay, and then it says on November 15th, which notice is exactly 10 days from the date of the invoice, we paid the amount due from the November 5th purchase, less the return on November 7th. So guess what? We are going to take the discount. Well, here's what I like to do. I like to fill in what I know and then fill in cash. Okay? So here's the deal. Even if we take a discount, they have to give us full credit on our account for what we owe them, and we owe them $57.50 right now. Okay? Even if we take the discount, they're going to get less money, but they can't treat us like we still owe it, because we're getting full credit for what we owe them. Guess where the discount goes? Well, when you keep a perpetual inventory, we're actually going to reduce the inventory cost by the discount that we take. Okay, well, what is 2% of $57.50? I believe it is $115. So I'm going to reduce inventory for $115. Then I figure what I'm going to pay in cash, because I'm going to pay in cash the difference to make this a balanced entry. The total bill we owe them minus the discount we get to take means that we're going to write them a check for $56.35. So let's talk about this deal about why we always use the inventory account. Let's look at inventory. When we first bought this stuff, it was $6,000 for 600 units. Okay? So that's $10 per unit. Okay? Then we sent 25 units back, and that got us down to $57.50. But guess what? That's for 575 units. So that's still $10 a unit. But guess what? When we take the discount, we're actually reducing the cost that we have in that inventory, because now we've only got $56.35 invested in that inventory. And guess what? It's still for 575 units. So see, we didn't really give $10 a unit. We gave $9 and something a unit. That's how perpetual inventory works. We're working with the real cost of the inventory. If we had to pay freight, we would dump it into the inventory cost, and we would make our unit cost be higher. Okay? Same thing. All right, very good. So that takes care of some purchase transactions. I'll start another video for sales transactions.